Okay, so in this second video and in continuation with the previous one, now let us think about a workable strategy to capitalize this concept and see if we can benefit from this typical price action which we see often and often in the market. So what we observed that generally when there is a contraction of the band, the price has a tendency to move to the mean and it stays there sometime around the mean, and then of course after some time it has to break out and go away from the mean. So the longer theory says the longer it stays near the mean, the stronger the breakout will be after that, which means it will move at a further distance from the mean, but we don't know to which direction. That is the problem playing with the volatility. So how the volatility behaves is volatility contracts, volatility comes down to a point, it becomes calm, and then when the storm comes, it can move to any direction based on the fundamental news or any unexpected event happens. So but the direction is not confirmed, but only one thing is certain, that it will move at a faster rate away from the mean, either to the north or to the south. That's the problem to do a directional trading. It's very uncertain. But the breakout trades, what happens in the breakout trade is normally people try to anticipate first. For example, from here people try to anticipate and see where it is going first, away, in which direction. So in this case it is going southwards, so the price is falling, and then people anticipate that it will further move away. So from this breakout zone, from this congested zone, it will further move away and continue to move downwards, which happened in this case. But it always doesn't happen like this. There will be so many false breakouts. For example, take this case. Here it was around the mean, then it slightly moved away, so people might have thought that it broken out northward, but after moving some time it just completely reversed and moved downwards. So this is a clear case of false breakout scene, but that happens, that is a part of the thing. So now let us see that, so what is the best way now to identify a breakout moment. So the best way I think is you wait for bands to contract, wait for market come back to the mean, and then anticipate that now things are stabilized and bands are contracted, price is around the mean. So now price will move away from the mean and will reach to the standard deviation, or towards the standard deviation end. So normally what happens in a normalized distribution, price in 69% of the time, price always stays between the mean and 2 sigma. So plus 2 sigma and minus 2 sigma. So that's what the Bollinger Band defines, the typical Bollinger Band which saw earlier, that defines those areas. The 69% of the time price will remain in between those two bands, and otherwise in some extreme events price can go beyond that as well, but anyways that's not relevant here. So we wait for the bands to contract. So there has to be a very clear definition that the top one has to start falling, which basically means the previous value has to be higher than the current value, which means the band is coming down for the first time. And the bottom one also has to be climbing, which means the previous value has to be lower than the current value. So that identifies the contraction. Once the contraction is identified, it should wait for price to reach the green line here, mean, and after that again it will wait for price to reach one of these blue lines. So either the top one and the bottom one here, these two blue lines. And when price reaches the blue lines, we can assume that a breakout is in the card, and in this case if it is down blue line, bottom blue line, then we can go short in the market, we can sell in the market and wait for price to further fall down and reach this red line here. If it goes to the, here in this case, after touching the mean, if it goes to the above green line, top green line, then we expect there is a buy breakout happening, and at this blue line we can long the market and wait for profit to be booked at this red line. Though after you booked the profit at this red line, market has continued north in the north direction for a very long time, but you cannot expect to reap all the profit from the market. You have to be satisfied and strictly follow your rules and go as per your logic. So that is a primary framework, the conditional. Now let us see what is VIX and what is volatility, how traditionally volatility is measured. It is very difficult to get an indicator, which will show on screen that how on real time the volatility is changing, particularly for the currency markets, because VIX is normally not calculated for the currency market, it is calculated for the stock market, and VIX is particularly used, this term is particularly defined for S&P 500 stocks. So the total volatility of the S&P 500 stocks, the index, is reflected in the VIX. But after many searching on the internet and different forums, I have found an indicator which is actually designed in a very similar fashion using the same logic and calculation equations which is used for the VIX, but this can be applied here as well. So let me put that indicator on my chart. It's called synthetic VIX, this one. So this is how it looks. So when the VIX values are here at the bottom part, we can assume that the volatility expected, actually the implied volatility, that's called implied volatility, the market is expecting very low volatility, and when it has gone at the upper zone, at this zone, the volatility implied for the next periods are very high. That's what the market expectation is. So that is the basic difference between what we see here and defining volatility and what VIX tells us. What we see here is actually the actual deviation from the price, and we can see that we call it, when the bars are expanded, it's a volatile situation. When bars are contracting, the price is hovering around its mean, so it's a calm period, less volatility. But VIX doesn't tell us that thing, because VIX looks into the future. What VIX tells us is that what the market participants are thinking right now about the volatility for the future period. Normally in stocks case, it is normally for the next 30 days. So there is a difference between VIX and this band expansion. Statistical, this is purely statistical thing. This is not just statistical, there are so many other factors involved here. What people are doing, they are writing calls or they are writing puts, so depends upon a lot of other factors here. But one thing is sure, if we look at the VIX, if we go back and see what VIX does and how it works, it is never a one directional thing. VIX is always a mean reversion indicator. It has got a mean reversion nature. So whenever it goes up, it stays there for some time, and then it has to come back, and it comes back to the very bottom level. It goes up and then again comes back. So most of the time the VIX stays at the lower zone, or it touches at least this lower zone, and sometimes it goes up. Again here it goes up but came down, goes up, comes down, stays there for quite some time. So one condition we can incorporate into the logic. Another logic is keeping our all previous logic same, we can tell that this is just a confirmation confirmation logic that when we open a trade at any point, we can also look at that particular point what is the status of the VIX, where the VIX is. So for example, here we can see probably there is a trading opportunity. Price after touching the mean has come down here, and then we can see that bands are also looks like they are contracting. So we, since it's a lower band, we can short the market and wait for market to reach the red line, but that didn't happen. Before touching the red line, market went back to the mean again, and probably we have booked a loss. So we have to sometimes accept that our anticipation, our forecast was wrong. Yeah, that can happen in fact 50% of the time. We cannot say sometimes. It can happen even for the best professional traders. 50% loss rate is not very uncommon. So yeah, okay, so it didn't follow the, so it didn't break out, so it was a false breakout. And we can see here the VIX was at a very high level at that point, so we can avoid these things, this situation, or these periods when VIX is already at a very high. We'd always like to take trade when VIX is at a very low level here and wait for volatility to break out, so the VIX goes up, and then meeting that condition only, we can think about or consider taking a trade. So this is just a kind of filter. So this, the previous rules is a generalized rules, but to cut down the false breakouts, we can take the help of a filter like VIX, and we can define a value of the VIX. Like here it is, you can see on the left, it tells us the value. So it is 0.24, 0.25, 0.23. So we can, by historically observing, we can define a value like 0.20 and put a logic there that if at the moment of taking the trade, if VIX is less than 0.20 or some value near it, then only it's a valid trade. And because we are expecting volatility breakout, we are expecting market breakout, so we'd never take trade when the volatility according to VIX calculation is already sitting at a very high level, like in this case. So we will wait for the VIX to come down and then take a trade. So that's the whole logic around it. That's all for this video. Now we can talk about some other things in the next video.